Hey, Eric here from 5minuteinvesting.com, and welcome to the technical analysis course. So this is the second video of the technical analysis course. So if you haven't watched the first one, go back and watch it now. So by this time, you should have my exact charting template, which is right here, that you copy and pasted into TradingView. So if you don't have that yet, remember to go back to video 1. So the question of today is, how many indicators should you use for your chart? I still remember when I first started, I was using way too many indicators. I was trying everything I could get my hands on. At one point, I had 20 indicators. Basically, whenever I read a book, they use one indicator, I add it on my chart. I read some forum posts, I see another guru use another indicator, I add it on my chart, and I was trying to see if there's any hidden patterns or if there's any indicator that works better than another, and so on. And at the end of the day, I was really confused because I had 20 indicators and the chart is always moving and I was overwhelmed. And I lost money because I was confused, frustrated, and so on. So today, I'm going to share with you my result. After years of testing, I find that you don't need that many indicators. In fact, you only need 2. So this video is going to explain why you only need 2. And the secret is in understanding price. So before we start, this is the chart, and you'll notice that I only have 2 indicators, which is 1, the Bollinger Band, which I'll explain later in detail, and 2 EMAs. The red one is 50. That means, so right now we're using a weekly chart, so each candle is 1 week. So 50 means I'm getting the average price for the last year. And 100, which is the blue one, means I'm looking at the average price for the last 2 years. Let me double check that. Of course, I was mistaken. So the red one is actually 100, which means I'm looking at the average price for 2 years. And the blue one is 200, which means I'm looking at the average price for 4 years. So if you see that price is above the red one and the blue one, means you have an uptrend. But I'll get into that in a bit. So the question today is, why do you only have 2 indicators? And that's because when you look at price, there's only 2 parts. So here I am at my whiteboard, and there's only 2 components. The first component is that price behaves like waves. So it's kind of like this. And people in finance call this volatility, which is just another word for fluctuation. So then if the stock fluctuates more, then the more volatile the stock is. For example, the more popular the stock is, chances are it will move more in the markets because there are more people trading it, and hence the volatility is higher. In the simplest term, it is the ocean wave. So you can think of a calm sea where the volatility is low, and a very rough sea where the waves are huge. So there's that part. This is the first part. And the second part is the trend, right here. So there are 3 types of trend, which is an uptrend, which means generally, even if the price fluctuates up and down, generally is going up. A horizontal trend, that means the price is just fluctuating and not going anywhere. And this is the kind of trend we want to avoid. And finally, a trend that is down. And that's usually when, the stock itself is not doing good. So trend, the second thing. So, and that's what you want to avoid, a downtrend. However, if you like short selling, you might want to invest only in downtrend, which is fine. But because the stock market has a natural tendency to go up by 7% a year, so the stock market, real estate market, these kind of markets has a natural uptrend. So it's very important to keep that in mind. So since there's only 2 components, you only need 2 indicators, and that's it. And as long as your indicators that you choose covers both of these components, then you're good to go. So in our case, if you look at the charting template that I gave you, for volatility, we have Bollinger Band. And for trend, we have exponential moving average, which is EMA. And that's it. You don't have to use EMA and you don't have to use Bollinger Band. But what's important is that you have two indicators or two methods that help you easily identify the trend and the volatility. And if you understand this concept, technical analysis is a piece of cake. So in the next video, I'll talk about how to identify the high and low without using any indicators. So we're going to train you as if you're starting from scratch, as if you're using the naked charts, which means you don't add anything special on it, and identify top and bottoms. And if you get good at picking top and bottoms, then your entry price will be better, and you'll enter at a more favorable price, which means you get stuff cheaper and a higher return. So I'll see you in the next video.